The financial statements looked healthy. Profits were rising. Analysts praised management. Investors celebrated record earnings, and stock prices climbed. Everything appeared to be working exactly as intended. Yet months later, the company collapsed. When investigators examined the wreckage, they discovered the warning signs had been visible for years. The evidence was buried in the cash flow statement, even as the income statement continued to report record success. The company was reporting massive profits while quietly running out of money. Modern economies rely on trust. Investors provide capital, banks issue loans, and suppliers extend credit. All of them need a way to evaluate whether a business is healthy. But counting the cash in a bank account rarely describes the full economic reality. That limitation led to the creation of accounting. Its primary goal is not to track every dollar coming in and out. The system exists to estimate economic activity. Imagine a factory spending $500 million to build a new production facility that will operate for 20 years. If that entire expense appeared on the books immediately, the company would report an enormous loss, despite having just created a highly productive asset. Investors receive a distorted picture of the business. Rather than recording the full cost at once, accounting spreads the expense across the asset's useful life. This timeline shows the immediate cash outflow as a massive drop, while the accounting rule creates a smooth curve over 2 decades. This concept is called depreciation. To understand this impact, you must look at the 3 major financial statements. The income statement attempts to measure profitability. The balance sheet measures resources and obligations, and the cash flow statement tracks the actual movement of money. These 3 statements provide different perspectives on the same business. When viewed in isolation, the profitability metric can mask the underlying cash reality. This disconnect happens because of accrual accounting. It is a system that records economic activity when it occurs, regardless of when the cash actually changes hands. Suppose a software company signs a $100 million contract. Revenue appears immediately, so the reported earnings line spikes, but cash collection is delayed, leaving the cash line flat. As this gap widens, one metric shows success, while the other reveals a company lacking actual money. Executives face pressure to manage this gap. Compensation rewards consistent earnings, analysts praise profits, and stock prices react in seconds. To hit those targets, management can utilize the flexibility built into accounting rules. By making different choices about depreciation timing, revenue recognition, or expense classification, they can alter reported profits. It is entirely legal judgment. This pressure creates the concept of earnings quality. High-quality earnings are supported by strong cash generation. Low-quality earnings depend heavily on accounting assumptions rather than money coming through the door. Accounting flexibility is frequently tested during periods of aggressive corporate growth, particularly during acquisitions. During an acquisition, the purchase price often exceeds the tangible assets. This excess premium forms a block called goodwill, representing intangibles like brand value. If these benefits fail to materialize, this goodwill must be written down, acknowledging a financial failure that already happened. The accounting loss is recognized years after the business loss. In corporate acquisitions, the numbers often react long after the economic reality has deteriorated. Another accounting debate emerged with the rise of stock-based compensation, a mechanism technology companies heavily utilize to fund rapid expansion. The logic is straightforward. Rather than paying employees with cash, firms issue company shares. This preserves capital for new investments and aids in aggressive recruiting. Economically, ownership is being transferred away from existing shareholders. The dilution is a real transfer of wealth. Yet, looking at the cash flow statement, there is zero actual cash outflow. Stock-based compensation proves a broader point about financial statements. They offer an interpretation of an economic event, relying on judgment and rules, rather than providing an absolute truth. Eventually, the system faces a shock. A recession begins, economic activity slows, and the limits of those corporate financial assumptions are suddenly tested. The consequences ripple through a company's operations. Customer demand weakens. Invoices that used to be paid in 30 days are delayed to 90. Unsold inventory begins to accumulate in warehouses. These operational frictions compress operating margins. As cash collection slows, existing debt burdens become visible to the market. Balance sheet strength becomes a matter of survival. Recessions reveal the underlying vulnerability of companies that relied on accounting appearances instead of generating actual cash. This reveals a central lesson of financial history. Accounting statements are useful maps designed to help investors estimate reality, but they are never the territory itself. Evaluating a company requires monitoring specific metrics: changes in working capital, debt growth relative to cash, and the accumulation of goodwill. The most reliable indicator of financial integrity is the relationship between operating cash flow and reported earnings. It all comes down to one question: when profits rise, is cash rising too? Many of the largest corporate collapses were not hidden in secret ledgers. They were visible in plain sight on the cash flow statement.